All right, let's dive into the crazy, high-stakes world of tech startups. Everyone's chasing that next unicorn. But how do you actually spot a billion-dollar idea from a billion-dollar bust? Well, the answer might not be where you'd expect.
Here's the brutal reality. For every single success story you hear about, there are nine that fail. A staggering 90% of all startups just don't make it. And that's a massive, massive gamble for everyone involved. Founders, employees, and especially the investors betting big on them.
So, what's the secret sauce? What does that successful 10% have that the others don't? It's not always a brilliant business plan or some viral marketing trick. A lot of the time, the real deciding factor is hiding in plain sight, the technology itself.
Yeah, when you really dig into why so many of these companies fail, it isn't always about running out of money or getting beat by a competitor. A huge number of them, especially in tech, fail because their core technology just wasn't ready for prime time. Maybe it couldn't scale, or it wasn't secure, or, it just plain didn't work like it was supposed to.
And this is the absolute worst-case scenario. You remember Theranos, right? They promised to completely change healthcare with just a single drop of blood. They raised hundreds of millions, got a massive $9 billion valuation. The only problem, the tech was a total fantasy. It's a really dramatic example, but it's such a powerful reminder. If you don't have sound technology, everything else is just a house of cards waiting to fall.
Okay, so if the tech is so incredibly important, why do so many people get it wrong? This brings us to a huge, glaring blind spot in how we traditionally figure out what a startup is worth. We look at the market, the money, the team, but the actual tech, it often just gets a quick glance.
I mean, just take two of the most popular ways to value these early companies. You've got the Berkus method, which has 5 key factors, and technology risk is only one of them. Then there's the scorecard method, which might give product/technology a weight of, say, 15%. But in both cases, it's basically treated like a checkbox. Do you have a prototype? Yep. Okay, great. Moving on. They're not asking the really deep, tough questions about quality, or if it can scale, or if anyone can just copy it. And hey, don't just take my word for it. This little piece of data comes from a survey of over 1,200 professional investors, people who invest in deep, complex tech. And get this, nearly a third of them, admit that they feel like they're flying blind, that there are major risks because they don't really get the tech they're pouring money into. When the experts feel that way, you know we've got a problem.
So, how do we fix this blind spot? Well, a new study decided to go straight to the source. Instead of just recycling old models, the researchers went and talked to the people who are actually on the front lines. We're talking investors, founders, mentors, and academics who live and breathe this stuff every single day.
And their approach was actually pretty simple, but really rigorous. First, they did a deep dive into all the existing research to see what we already thought we knew. Then, and this is the cool part, they used something called the Delphi method. It's basically a structured way to get a group of experts to agree on something, where they all answer questions in multiple anonymous rounds. It's designed to filter out all the noise and personal bias, so a clear, collective expert opinion can rise to the top.
And this is where it gets really, really interesting. Out of all that work came a definitive checklist. Not just some vague idea of technology risk, but a concrete, actionable list of the specific things that the experts all agreed are absolutely critical when you're looking at a startup's tech.
Just look at the top 3 here. These are the absolute non-negotiables. First up, with a near-perfect score, is scalability. Can this tech go from being a cool lab experiment to something that's mass-produced? Can it handle 10 users and then 10 million users? Second, validation. Is there actual hard proof that this thing does what they say it does? And finally, the technical team. Does the team have the skills to not only build this thing, but also to grow it and support it down the road? Seriously, without these 3, you've pretty much got nothing.
But wait, there's more. It doesn't stop there. Other super important factors made the list, like being compliant with legal requirements, because you can't just break the law, no matter how cool your tech is. How hard is it to copy? That's where a strong intellectual property strategy comes in. And what's the maturity of the technology? Is it just an idea on a napkin, or is it a system that's already been tested in the real world? All of these things add up to a way more complete picture of the real risks and, of course, the potential.
Now, having a checklist like that is a fantastic start. It tells us what we should be looking for. But the next logical question is, okay, how do we actually use it? How do we turn this list of components into a practical tool we can use to make decisions?
Because that's the real challenge, isn't it? It's one thing to say, oh, scalability is important, but it's a whole other thing to try and compare the scalability of, say, a biotech firm to a new software company.
How do you put a number on these things in a standardized way so you're not just comparing apples and oranges?
This is where the study got really clever. They turned to this tried-and-true tool from the world of product development called the House of Quality. For decades, huge companies like Toyota and Ford have used this kind of matrix to translate what customers say they want into concrete engineering specs. The researchers had a light bulb moment. What if they could adapt that same tool for valuing startups?
So instead of translating the voice of the customer, they adapted it to translate the voice of the investor. On one side of the matrix, you have what investors are always looking for. You know, high growth, low risk, stuff like that. Pretty vague, right? But the framework acts like a translator. It turns those vague desires into what the startup must deliver on a technical level. Things we can actually measure, like proven scalability, a defensible IP strategy, or a team with the right skills. It's a game changer.
So what this really does is create a shared language. For founders, it's a clear roadmap of what you need to build and what you need to prove to be taken seriously. And for investors, it moves the whole decision away from just a gut feeling about the tech and toward a systematic, data-driven analysis. It replaces all that uncertainty with clarity.
And that really brings us to the final question. You should be asking yourself whether you're building a company or thinking about investing in one. Is your technology truly a unique asset that's driving all this value? Or, without proper validation and a clear strategy, is it actually your biggest hidden liability? This new framework finally gives you the tools to find out. Thanks for watching.